thrilled to have her back on campus.
Thank you so much, Dan. And yes, these were some of my favorite days being here. So it's an honor to be back and very fun to be back interviewing you, Mark, because I've got to say you've been one of my favorite interviews in the last couple of years. We'll go back to that interview towards the end. First, though, I think we should take a big step back and kind of just look at the environment we're in, because it's been very volatile. A lot of questions about where the economy is going and what that means for different asset prices. One thing I do in the morning, the first thing I do, I'm a very cool person to wake up and look at the 10-year when I wake up first thing in the morning every day. But, you know, we're above 4.3%. It's been fluctuating all over the place. What is it saying to you? I mean, a lot of the reason you've seen that longer end of the yield curve really drop down in recent weeks is because people are worried about growth. People are worried about the economy. You're hearing the word recession more and more. How do you feel about the direction of travel?
Well, first, thank you for having me. Always good to see you. Look, what's happening is everybody's nervous, right? And the markets have no idea what's going on. What markets love is consistency, and you don't have that right now. And the reason you don't have it is President Trump can wake up today and say, I want 200% tariffs on champagne, which he did. And then the next day he might say, okay, I'm going to reduce it to 50%. So the problem for the markets is when they don't know what to do, people just don't do anything, right? And when you don't do anything, it stops you from sort of putting out orders, from spending money, because everybody's waiting to see what really happens. An economy can't survive like that. So what ends up happening is when growth stalls, you're going to find that the only way you're going to restart that economy is by reducing rates. And that's sort of what everybody's waiting to see, because nobody really knows what is going to happen tomorrow. And that's the reason you've seen the market just continuously go down, because one minute you think, okay, everything's gotten solved, next minute it comes right back. So uncertainty is not a positive thing.
When you say the economy can't survive like that, what exactly do you mean?
What I mean is you either are retrenching or you're growing, right? Nobody just stops, because what you're trying to do is take advantage of situations so that you want to be the one that's doing something that your competitors are not. But if right now everybody is stalled and is just waiting, that's bad for the economy because money isn't being spent, goods aren't being purchased, so everybody's waiting for, all right, you know what, I'm not going to do anything this week, I'll wait till next week, or I'll wait till next month until there's more certainty. And what that does is it just slows everything, and you could push this economy into a recession.
Right, do you see that being the ultimate outcome?
I don't know yet. I think I don't know what he's trying to do. I understand, you know, the thing with tariffs, but I don't know what is really happening. So for somebody like us, it's actually great, right? Because we take advantage of turmoil. So as you see pricing going down, we'll buy into that because I still believe the economy is solid. And ultimately, even if it slows down, rates coming down will just jumpstart the economy again.
So, and by the way, by the end of this conversation, we'll open up for the next 10, 15 minutes at the end for questions. So have those in mind, ready to go. You mentioned being able to take advantage of the turmoil. How have you been doing that lately?
Well, for us, I think it's just, if you think of 4 weeks ago, everybody was of the belief that things were going to be great. The economy was going to do phenomenally well. It was going to be really positive. Pricing had gone up, right? So for us, it was just a little bit harder. And now what you're really seeing is you're seeing that as people are nervous, pricing is going down. I think the market's down 10%, but credit is down. Everything is down. So for us right now, all we're trying to do is just give down bids and try to find people who are really nervous.
Well, how much conviction could you have right now in kind of big bets, given that things are still moving around?
I think we have conviction on what we're buying because it's from a credit standpoint, you're very comfortable that at the end of the day you're still going to get par. Whether there's more issues, the uncertainty that's there is negative for a lot of people. It's positive for people who do what we do.
So if you think about, let's take a big step back. You mentioned tariffs for a moment there. There are a lot of people who believe that even just the uncertainty of tariffs will start to impact performance of these companies. Ultimately, what do you think the impact is going to be, even if the president doesn't get as aggressive as he's initially laying out with some of these tariff policies?
I think the problem is really, imagine if you have a business and all of a sudden the cost of your goods has gone up 25%, right? The consumer is just going to buy less. So whether it goes up 25, it goes up 50, if you're doing tariffs on cars, no matter where you're doing a tariff, that extra cost has to be borne by someone. And the problem with tariffs is there's a belief that the party that's going to bear that cost is the manufacturer, right? And it's not going to be the consumer. I don't believe that, right? I think President Trump believes that. I think what ends up happening is everybody's already operating under razor-thin margins. Nobody's got these massive margins. And so you're going to find that as tariffs goes up, the cost goes up, that all of a sudden the consumer is going to say, well, it's 25% more. I don't want it. And that has an impact throughout the world because U.S. exporting, U.S. and then other countries are sending their goods here. You're going to find that the consumer is going to spend less, and if a consumer spends less, then you will have a recession.
So even without a recession, even if you didn't believe we were getting there, what parts of the economy are going to face peak damage? And are there places that you would entirely avoid?
I don't think we would avoid anything. It's what you always want to look at is what's happening on the credit standpoint, right? So what's the value of the company or what's the total enterprise value and where can you buy it today? And are people nervous? So on the automotive industry, if steel is coming in and it's going to be more expensive, you're going to have cars that are going to be more expensive. So it's going to be harder for people. For us, I'd still rather buy bonds from Ford that are trading. If I can make 12, 15% on that, I will, because I'm not worried about Ford going into bankruptcy.
Is that a trade you're placing today?
We're looking at it. I won't.
So, I also want to point out, too, that you actually have intimate knowledge of how this president negotiates based on your experience with him in the past in business. And this is through the Trump casinos. This is in the early 2010s, roughly, that you kind of went through the entire bankruptcy process in and out with the Trump casinos. What can you tell us about the way he negotiates?
He's different. I think Donald just moves forward. Like, think of it this way: there's $300 million of bank debt, there's $1.5 billion of bonds, and then there was the equity, and he had the equity. The bonds were trading around 5 cents, and the bank debt was trading around 70 cents. And every meeting, I would have lunch with Donald once a month, and he would always say the same thing. I want half the equity, half. And I'm like, why would I ever give you half the equity? I'm going to crush your soul. And he would always say, every month, we'd have lunch. He goes, are you going to give me half the equity? I'm like, no. Why would I do that? Under bankruptcy law, I'll get all the equity. And you just would then have lunch. And you'd have a great lunch. You would talk. It's as if he totally forgot about what he was asking. And every month we would just have the same, give me half the equity. No? Okay, let's have lunch. And, that's how it went. And then ultimately at the end, we got we got all the equity. We gave him 5% of the equity because we wanted to keep on using the name. And the good thing, we got along really well. Everything worked out really well. I mean, for us. So it was all good.
Well, does it mean, do you see some of the ways that he worked in business playing out in the presidency as well? Or is there something completely different and more unknown about the way he's serving as president this time?
No, I think he just always is moving forward. And, he wants to do something and he'll do it. And if somebody stops him, he'll go, okay, and then he'll just go do something else. I mean, he's going to constantly keep moving and trying to change things. He loves chaos. And the more chaos there is, the better it is, because most people don't like to deal with chaos.
So let's also take another big step back for a moment, because as was alluded to in the opening remarks, the financial system is changing very quickly. Avenue Capital has changed a lot over the years. You now do a lot of private work in private markets, private credit markets, growing very fast and changing very fast. What would you say the biggest difference is now about Avenue and the way you invest versus even 5, 10 years ago?
It's a great question. I think what's happened over time, there's just less bankruptcies. And the reason for that was because you had a lot of capital. So for us now, what we're doing is specialty lending. We're lending money to firms anywhere between, I would say, 10 to 15%. So 10 years ago, 80% of everything we did was we'd buy public bonds. It was distressed. And today, I would say 90% of what we do is specialty lending. So we've gotten into the business of just lending, and you'll make a 1-year loan, 2-year loan, because if you can make 10, 15%, it's actually a great piece of paper.
How much of that is tied to private equity-backed sponsors?
Not as much. Private equity is going to be more direct lending. So those are companies that actually have no issues. When you do specialty lending, nobody's coming to us to borrow money at 12% or 14% because everything's perfect, right? There's an issue. And I think we'll get paid off, obviously, but what we would love is that the loans we make, that we end up getting control of the company. It doesn't really happen because somehow we always get paid off.
Well, to that end, do you think that there's more kind of trouble under the surface than meets the eye? There's been so much activity moved to private markets that I think a lot of investors have been having a hard time getting a sense of what's actually happening in the real economy.
I think there's problems. Look, when everybody borrowed money, they borrowed it at 1%, 2%, right? Today you're paying 5%, 6%, 7%. It's always prime plus 2, right? So you're paying around, I would say today, whether it's prime or SOFR, you're paying, if you're a good company, somewhere between 6 to 9%. So that's going to have an impact, right? People didn't put that in their models. So I think it's all fine if the economy is growing 2, 3% a year. But if the economy slows down and you've got higher interest rates, you'll have issues. Yeah,
because there's kind of a whole generation. If you graduate, I graduated college in 2012. Since then, there really hasn't been a significant downturn barring COVID. And so there's a whole generation that's never invested in an interest rate environment this high. Do people know what they're doing?
Hopefully not. Hopefully you guys will help me.
Well, so what does it mean then? Do you see people making mistakes?
Yes. Yeah, it's great. There's always mistakes. I mean, there are, and there's always issues. And, the problem is, so if you're an equity player, equity players look at debt players and think they're really stupid, right? Because they're like, why don't you buy this stock? I could make 10 times my money. Whereas a debt player goes, why would you buy the equity? You could lose all your money. I'd rather know that I'm going to make my 10%. And I think the vast majority of people are more equity players, right? Because if you sort of look at what's happened in the last 10 years, equities have done exceptionally well. So credit, anybody who's done credit has done well, but equity massively has outperformed. So I think what you're going to see over the next couple of years is credit is going to outperform equity.
Interesting. So is that part of the function of being of the rate environment that we're in? Do you think rates will stay higher for longer, in essence?
No, I think rates will actually, I think rates will start coming down just simply because the more nervous people are about the economy, the more you have to put money into the economy. So they'll lower rates to start the economy going again, but I think you'll see that in the next 6 months.
So when you think about the structural changes that are happening in the banking system, how much of that is contributing to how much your business has grown in the areas that you dive into? Is that a function of where banks are stepping back?
Yeah, banks have, I think 10 years ago, every single bank was doing asset-based lending. Today, banks aren't, they've pulled back. You've got funds, I mean, on the direct lending side, it's hundreds of billions of dollars that have come in, and banks have pulled back on that. Part of that is Basel II, Basel III. A lot of it is regulatory. Like, think of this. This makes no sense. You had a bank in Ireland. So, is anybody here Irish? Before I speak ill of the Irish. So Allied Irish ends up being told by the government under Basel III that they've got to get rid of corporate loans, right? So we buy the portfolio. So we buy the portfolio from them, and then Allied Irish turns around and lends us money to buy the portfolio, right? So it doesn't really make sense, but the reason they did it is because government's saying you have to get rid of corporate loans. So by doing the deal with us, they had more equity. We put in 50 cents. And because of that, Allied Irish used to charge about 6%. We're charging 12%. So the only people who got hurt in all of this was the consumer. And what you've got is always structural issues because governments are worried about one thing, systemic risk. And so they don't want the banking system to fail. So they'll do things to protect the system, which is good, but then it hurts people along the way with higher rates.
Yeah, speaking of unintended consequences, I'm really interested in seeing how you think the private capital world is evolving. You said you're doing more specialty lending, not as much private equity-backed lending. I think another moment that we're sitting in now is of the private equity firms that thought that they would sell their companies into public markets. None of that is happening. What does that mean in terms of the types of pain you might see in private markets this year, next year, beyond?
For you to see pain, you've got to have a recession for a year or two. I don't think you're going to have that. I think what will happen is everybody was all excited at the beginning of the year when the market was up 10%. Everybody was thrilled. Oh, we're going to be able to sell our companies. IPOs are back. It's all positive. Now what's happened is with the market down, it's going to be harder for people to sell their companies or for somebody to buy. And the simple reason is the ask is still here, right? Even though the value has gone down. So you're just going to find a bid-ask spread that's going to be too big. And what that means is everybody's going to wait. So you're either going to wait for pricing to come back or pricing is going to get lower.
Would you argue here, and this might be the most divisive question that I ask people, I think. It's crazy how annoyed people get at this question, but marks, private equity marks, private credit marks even, do you think that they are wildly different than what's the reality right now, given that you have seen asset prices change so much?
People get upset?
People go crazy.
Yeah. I think where somebody's going to mark something and where another private equity firm marks it's going to be totally different. And the reason is one firm is going to say, we think our equity is fine. Another firm is going to say, well, the bonds are trading at 75 cents. So the market or the credit market is telling you that the equity's got problems, so we should mark the equity down. So that firm may mark it down. But I think you will find totally different marks from different groups who are in that same equity.
So what kind of problem is that creating among different types of borrowers and equity holders? It looks like it's starting to get pretty ugly out there.
Yeah, you need time. I mean, for things to get bad, you need to have, nothing's going to happen next 3 months, right? It's got to be 6 months of turmoil. It's got to be sort of, like, I don't understand. I'm like, if you sort of think about it, any business, what you have in a business, who are the most important people in your business? It's the people who collect money, right? Who's doing the accounts receivable? So if you think of the U.S. government as a business, who are the people who collect money? The IRS, right? And if you fire everybody in the IRS, what you're really telling the American people is, don't worry about it. You should be super aggressive on your tax returns because we're not coming after you. There's a lot of things that are going on that everybody's trying to understand. But I think for businesses, you still have the luxury of time, whether that's 3 months, 6 months, or a year. Rates will come down if people get very nervous or if the Fed starts getting nervous. The inflation numbers were flat to down. So what you're going to see is everything's going to stay where it is for another 3 months before rates come down.
So speaking of the government, I mean, I think a lot of people underappreciate how much of a force it is underpinning a lot of the market activity that we've been seeing. And the fact that they're not only taking the foot off the pedal in terms of how much they're pumping into the economy in terms of pure dollars. You think about the DOGE efforts, for example, layoffs across the government, but also the fiscal situation of the United States just alone. A lot of people, I think this has been a years-long conversation that has been a concern. When do things come home to roost?
I know everybody wants it to happen right away. It's going to take a while. I think what ends up happening is you'll have issues over the next 3 months, and what will happen is either Trump is going to keep on doing what he's doing, and the more uncertainty that's in the markets, the more you'll find that the markets will, keep going down or level off. Once he removes that uncertainty, markets will come back. If that uncertainty remains and inflation starts coming back up or the economy slows, you'll see rates start coming down, and the more access to money that you have, the better it is for the economy. But I don't think you're going to see anything over the course of the next 3 months. You're just still everybody's going to keep on waiting, which again is not positive.
Now, with my last 10 minutes, I'm going to do a little bit of a hard pivot because one place that you have kind of gone, you're famous for your work in credit markets, but you've become also more famous because of your work in sports. One question I have for you is there a parallel? Is there something to be taken from the way you've invested in credit to what you've translated into sports markets?
I think so. I think when I bought the Bucks, the biggest problem you have in sports, so here, we'll do a test. Who here thinks talent wins in sports? Raise your hand. Okay.
Does talent win in sports?
Right, talent. Who thinks team wins in sports? So, right there, that's your dilemma. When I bought the Bucks, the big thing was, do you go for talent or do you go for team? The same thing at a firm. Do you want a portfolio manager who's a phenomenal investor but nobody likes, annoying, never want to deal with him or her, or you want somebody who's a team player, right? So for us, with the Bucks, the first thing we did was actually gear the organization to being a team. And we knew we had a superstar, we had somebody who was great, so let's all focus on how to make him better and make ourselves better. And when I bought the team, we were the worst in the league. And then we won a championship within about 5 years.
3, 4, 5.
So that was pretty unique. After I sold, They haven't gotten out of the first round. Just saying. Facts are facts. But somebody had asked me, I was on a panel, and somebody goes, so what was the secret? Why did you win a lot? And I said, well, I used to go in the locker room before a big game, and I'd look at the players and go, okay, we got to win. Today's the day. Focus. Look, ultimately, we had a team, right? And the team can accomplish a lot. And I think the big question in sports is, do you want a team or do you want talent?
So this was back to my favorite interview with you. I don't know if you remember this, but I had interviewed you right after you sold your stake in the Bucks, and you told me on Bloomberg Television that pickleball has a better rate of return. And the story went everywhere. I actually heard a rumor that the NBA called you after this.
They did.
Okay. So expand on that a little bit. Ever since then, you've got into golf, you've gotten into NASCAR. I mean, what are the opportunities that you see, and what do you see in those opportunities?
Well, first of all, in pickleball, I only made 100 times my money. So I know the NBA got mad at me for saying it, and I was like, just saying. All right, so here, let's do a test, and then we'll tell you how we're doing it. Who knows how many Americans are there in the country? 350. Great. All right. How many Americans watch an average hockey game on TV? 2 million? Is that 1 million? Less. So it's half a million. 500,000 watch average hockey game, and you get paid $700 million a year for media. Baseball, how many people watch it? Pardon? 5 million? No, 1 million. They get paid $2 billion a year. Basketball, how many people watch that? 5 million? 2? 10. 1.5. They get paid $7 billion. All right. So we just bought bull riding team. Has anybody been to a rodeo? All right. How many people do you think watch bull riding on TV? 100,000. 50,000. What'd you say? 1 million it is. It's 1 million too. More people watch bull riding than watch baseball. Do you want to know what their media deal is? $15 million. What you want to do in sports is one of the few things where they give you the answers in advance. So we bought a sailing team. I get to see what the ratings are. Sailing has been growing 30 to 50% a year. We bought a team for $60 million. Why? Because the ratings for sailing are actually higher than for basketball. You have close to 2 million people who watch a sailing race. And if you think about that, that means their new media deal, which is pretty low, it's 40 million. We think their new media deal will be pretty high. We'll make money on that. So what we're trying to do in a lot of things is we've bought into NASCAR. We've bought into the Baltimore Orioles. We've done, has anybody here been to COSM? Do you know what COSM is? So COSM is, you'd be sitting in a minisphere like this, and you'd be watching a baseball, basketball game, but it's all encompassing. It's like being in a planetarium. Sports is one of the few asset classes that the vast majority of people are not in. So therefore, you can invest. If you've got capital, you can do really well. So for me right now, investing in a lot of different leagues and sports. I'll give you the weirdest one. Imagine somebody comes to you and says, I got a great idea. We didn't do it, but we should have. Has anybody seen Power Slap? Do you know what this is?
No idea. You lost me a few sports ago.
All right, Power Slap is, I say, here's my idea. You and I are going to stand right here, and I'm going to slap you as hard as I can. And then if you can get up, you slap me as hard as you can. That's the sport. Not a complicated sport. All right? You have more Americans watching that than watch baseball. I mean, just think about like what's going on. I had one of our analysts said, you go through all this, and then he goes, all right, that's great. Quick question: what are the 347 million Americans? What are they watching? If you've only got like hockey, baseball, basketball is 3 million. What's everybody else doing, right? And that's what you're trying to figure out. And the way we do it is we see sort of ratings as they keep on growing, and that's when we invest in a sport.
So one more question for me, and then I'm going to open it up to the audience, so definitely have your questions ready. So in your time in the credit markets, we have a lot of students here as well. What are the best things that you've learned that they should know? What's the one piece of advice that maybe you've gotten from the greatest investors in the world that you would pass on?
All I would ever tell you is, look, you've got to believe in yourself, right? And what I mean by that is, if you sort of think of like Apple stock, somebody's buying it today, somebody's selling it. The person who's selling it thinks it's going down, the person who's buying it thinks it's going up. Ultimately, the way you're going to succeed is you're going to be able to see things that other people don't see. Whether it's a feel for the market, whether it's a feel for a credit, what to buy, what do you focus on that somebody else doesn't? And for you to succeed in this business, you have to make decisions. You've got to take risks. And if you take those risks and you turn out to be right, you'll keep on succeeding. And if you take those risks and you turn out to be wrong, this is the wrong industry for you. And you don't have to worry, you'll get fired. So it's not going to be that complicated.
On that note, let's definitely open up to more questions. Maybe how not to fail. Anybody?
Yes?
Just on the political front, I've heard some comments that Trump does not care about asset prices because of the populism of his base. What are your opinions on that?
I don't know if I agree with that. I think Trump's base wanted change, and that's what Trump is doing, right? So ultimately, we had a mayor here in New York called Ed Koch. I don't know if people remember him or not. And after he lost his election, he said he gets interviewed, and they go, well, what do you think? He goes, the people have voted. Now they must be punished. And I think we live in a democracy, right? And ultimately, at the end of the day, I think people voted for Trump because they wanted change. They wanted a lot of change. And that's occurring. And to me, it's not about asset pricing. It's just about change. And in 2 years, we will either be really happy with that change that has come about, or we won't. And if we're not, Democrats will end up winning. And so the pace of change will be a lot slower. But that's what people voted for, and I think people just want change. I don't think it's as much about populism. It's more of, I'm tired of DC, I'm tired of a lot of different things, and I want change.
One other question: what is your view on stagflation, given your view on the
my view on stagflation?
Yeah, just on your expectation that the tariffs will cause price increases.
I think they will. I mean, I don't know. To me, if all of a sudden you raise a tariff and things are more expensive, I just think you're going to have less people buying it. I'm not an economist. I just sort of know, like for myself, if I go to, I've done pretty well, and I still try to buy things on sale, right? So if all of a sudden you're seeing things that keep going up, are you going to buy it? I think it's just going to create real issues in the economy, and it'll slow down the economy. You're not going to make as much from the tariffs, as you will, from sort of collecting on taxes.
Mark,
Yes.
there's two questions here. First over here.
Okay, first one, you noted the impact of all the Basel requirements on the banks, which has resulted in a wholesale transfer of corporate credit risk to private hands
I agree.
over the last 2 decades. If we were, in fact, to enter into a period of stagflation, tipping into recession, I'm not saying we will, but the question is, what is your view about the sustainability of private equity and private credit funds to withstand that kind of a downturn?
I don't know the answer to that. And the reason I don't know is I just don't know how levered they are. Right? So it is. No, it is. That is the problem. Because the thing you have with regulated entities is you had this requirement you have to have 10% equity. Right? So for what you were doing and how you were marking things. If you're a direct lending fund or you're a private equity firm, I would have been less worried about it 5 years ago. But because everything has gone so well for 5 years, I think people have increased the amount of leverage, have taken more risk. And the problem is we have no idea what their portfolios look like. So we could find that there's a lot of issues.
Mark, following up on that point, first of all, I will be talking about levered and private credit later on. And one of the questions I'm going to ask the audience later, but you probably won't be around late in the afternoon, so let me ask you what you think. Do you think that the credit cycle leads, lags, or is coincident with the business cycle? In other words, does credit lead recessions and expansions, or vice versa, or they move together? What's your feeling on it? I'm going to ask the audience that as well and try to answer it, but I'm not sure if I will agree with you or vice versa, so I'd like to get your opinion.
Okay, what do you think?
That's a great response, but I asked you first.
I think what ends up happening is when people are nervous, they go into credit. And as you see more and more people going into credit, it's going to let you know that there's going to be a problem. People leave credit. It's always funny when you're in an environment where credit is making you 10%. You go through these stages where 10% is, oh, I'd be happy not taking any risk. 10% is great. And then you go through periods where only an idiot would invest in credit because equities have done so well. I think what you're seeing now is more and more people going into credit because you've got people who are nervous. The more nervousness there is, the more people are telling you that there's going to be a recession. So that's how I look at it.
Yeah, I kind of agree with that, but I'll
God.
take it later on. But one thing about credit is, and you're in distressed investing, and there are a lot of people here interested in that topic, it will take quite a bit of time for the distressed credit prices to be really attractive.
I agree.
To distressed investors.
Yep, they're still too high.
We're talking about 6 months, a year of a downturn in the credit markets before that happens?
It's going to be at least 6 months. I mean, you don't want to buy a bond at 80. You'd like to try to buy it at 50. So I know there was somebody over there who had a question. Yes.
About 6 years ago, in the spring of 2019, you were at a similar conference, I think it was ABI, and you were asked, where is the action restructuring thing going to be? And at the time you said it's going to be at the operational level. And it was, pre-COVID, rates were low, everything was good. Do you still believe that still, especially in light of so many zombie companies really walking, kind of standing and, on the back end of the credit easing and loose calves and so on? Do you agree that this is still the case?
I'm sorry, I missed the first part. I apologize.
Sorry, about 6 years ago, you were at an ABI conference, I think, and you were asked, where's the action in restructuring? And I think at the time you said, you believe that it was operational. You know, it's really at the operational level.
Yep.
Do you still believe so?
I think right now, in the last 6 years, companies have put on more leverage. So the more leverage that you have on a company, when you're in a time of stress, that's going to end up hurting the company. So 6 years ago, I thought there was less leverage. And the simple reason for it is people were still a little nervous. But you've gone through this huge period of growth over the last couple of years. And during that time, people have put on more debt on companies because you could and you should. If you could borrow 1%, 2%, 3%, you should have. Everybody thought you'd have rates staying where they are. The fact that rates are higher today, about 100% higher, will have an impact on companies. So you need to sort of see what happens over the next 6 months. But I think what will happen is rates will come back down, not to where they were. They'll come down about 50 bips. But that's still going to cause a lot of stress for these companies, if that's helpful.
I think we have time for one more question.
There we go.
I think you've chosen to stay based in New York, and I'm curious if you plan to stay in New York and what you think the advantages of being in New York are.
You mean, do I want to pay less taxes by going to Florida? I would. However, I'm married. And I have no choice in this decision. My wife's a big believer that we should stay here in New York. I'm more a believer that I'd rather pay less taxes. But in a marriage, there's always compromise. I've sort of found I compromise all the time to what my wife wants. So that's actually worked out very well. We've been married 40 years. Look, I think it's a real question. I mean, it really is. And I think states or politicians don't fully appreciate how easy it is for people to leave. And you're sort of seeing this exodus out of New York, whether it's to Texas, to Miami. You're seeing it from California, people moving. And it's a real issue. And I think it's a real issue for employees and for folks, because all people really care about, I would say, is they care for their family's safety. They want services. And as things keep getting more expensive, you start looking at what you're making. And then people start making economic decisions. Am I getting a lot for that extra 15%? Is living in New York that much better than if I went, to Tennessee or if I go to Florida? I would tell you in all seriousness today, I think I'd rather be in New York than not. But you're getting close to a point where I think for a lot of firms, especially people where you can work remotely, where it's a lot easier to move. Whereas I would have told you 5 years ago or 10 years ago, moving was really difficult. Today, it's much, much easier.
Mark, we thank you so much for your time today. We have
Thank
to
you.
let it up to the next panel. Thank you.
So if we can remain seated.